Hey guys, this is Islam from FX Trading Tools. In this video, I'm going to be talking about a forex strategy, and I will show you how to backtest your strategy or this strategy or whatever, any strategy that you are having, and I will show you how to use the moving average indicator. So without further ado, let's go to the chart. I already prepared this for you guys. This strategy is called 786. Well, in this strategy, I'm going to be using the Fibonacci levels, moving average indicator, and the market structure. So I'll be talking about Fibonacci for a while and then move to the next things. Fibonacci levels are based off Fibonacci ratios, if you have heard about them. Fibonacci ratios are basically from 0 to 1. 0, 382, 618, 786, and 886. Some people use the 50% or the 0.5, but it's not a Fibonacci level. In this example, I will just be using the 786. So I'm gonna go ahead and get rid of the other levels. This one, this, and this, and click on OK. Alright, this is what I'm gonna be using in this example. The moving average indicator is basically a mathematical calculation of the closing prices of 200 candlestick divided in a mathematical way that doesn't matter how, but I will show you how to apply it and how to use this moving average. Well, the moving average that we will be using is 200. Well, let's say that we don't have it because I put it up before. Let's say that we don't have it. I go to indicators and right here AMA, and you click on the first one, moving average. If you click on it, you're gonna see it here. So I pulled one, I will remove one. All right. I'll be using 200 and not 9. So to change this 9, you click on the gear here, and then you click on inputs, and you write 200. You type 200 here. You can change the color if you want. I'll put blue, and I will make it thick, and that's it. Okay. So after that, you will see it in the chart. This is my moving average. So how to use it? Well, if the price is above, I'll change this color to the green. If the price is hanging around above this moving average, we'll say that the price is going up or in uptrend. If the price is going down, we will say that the price is going in downtrend. I will show you an example. For example, here. The price is above the line, so the price is going up, and that's what the market does in reality. The same thing here, the price is below the moving average, the blue line, so say that the price is going down. That's how we're gonna use this moving average. The third thing that we're gonna be using is market structure. Well, the market structure is that the market doesn't go on a straight line if it's going down or up. In this case, it goes with an up move, pullback, up move, pullback, up move, pullback. This up move and pullback creates something called higher highs and lower lows. You have to know what does this means. I'm gonna try to explain it in just quickly. These points that you see here are the points that matters in this strategy. For example, we say that this is the lower low in this part of the market. This is the lower point, this one. So I'm gonna just go ahead and put a line here. This is the lower low, and this is a higher low, higher than this low, and this is a higher low, higher than this high, and like this, so on and so forth. Same thing in the upper part. This is a higher higher low. Excuse me. This is a lower high. All right, this is the lower high because it's lower than this high, and lower than this high. This is the highest part, this is the lowest part. So this is a lower high, higher high, and the higher high higher than this. And same thing here. You consider this as a lower part and this as the upper part. These points are very important. So this is a higher high, this is a lower high, this is a lower high, and this is a higher low because it's higher than this low, and this is a higher, and this is a lower low, and this is a lower low because it's lower than this low. So this part is low, this part is high, this is a lower low, this is a higher low, a highest low, and this is and so on and so forth. So you have to understand this structure that the market does. But before we say that this is a higher high, like for example here, before we say that this is a higher high, higher than this point, the market should break and close above this high. This is a high, for example. Before we say that this is a higher high than this, the market should break above this level and close above it. Break and close. Well, I will give you an example of this, but before that, I'm gonna go ahead and give an example of this strategy just here. So let's say that the market is moving like this. Move up and the pull back, and the move up and the pull back to this level and the move up. This is what we have in the data. All right, or maybe let's say that we don't have this. So I'm gonna try to use all these tools, and in this case, the first thing that you have to, first condition is that the market should represent a higher high and a higher high higher than this, and if this is the higher high, this becomes a lower high. So this condition is occurred only when the market broke above this high and closed above it. The market closes above this high somewhere here. All right, and then it pulls back. This is condition number one. So the market should create a new high. This is the new high, and this becomes a lower high, and this is a higher high. The market went up and closes and broke the previous high and closes above it, and then it retraces, and this retracement is what we're gonna use in our strategy. That's the condition number one. Condition number two, the market should be, if the market is going up, the market should be above, or the price should be above the moving average. Let's say that this is the moving EMA or moving average 200. So condition number two, the price is above, since this is the price, is above the moving average. The condition number three is the Fibonacci level. So I'm gonna pull up my Fibonacci level, and I'm gonna draw it from swing low to swing high, from swing low to swing high, and the price should touch this level. If the price touched 786, the price touched 786, which is my entry, I'm gonna enter the price. I'm gonna be a buyer since the market is going up here. All right, guys, the market is going up. So I'm gonna pull up my tool here, and I'm gonna enter in this price. It doesn't matter whether the price went down or it changed the direction. I'm gonna enter here at this price, and I'm gonna be putting my stop loss just below this low right here, like 10 pips below this low. If this is like 40, I'm gonna use 51. This is 10 pips below that, and I'm gonna use my take profit in this high since the you know that the market pulled back. So it's gonna, this strategy says that the market is going to do like this. It will go down, or maybe not, and it will go like this, or maybe like this, and maybe also like this. So what the market does now is it went in our direction. So like this is a good trade, and this is how I apply this strategy. So first condition, I'm gonna recap for quick. First condition, the price action should break above the high, this high, and close above it, and retrace to the second the second condition is moving average. The price is above the moving average, and it should retrace to this level 786 of the Fibonacci, and I will enter, whether I'm gonna be putting a buy limit or something, where I'm gonna buy market in here in this level, and I'm gonna enter knowing that my stop loss is below this low, and my take profit is just at this high. And the amazing thing in this strategy is the risk reward ratio, which is big. It's almost 3 if we know how to use. If we tighten the stop loss, it's gonna be almost 3. Well, this video is getting longer, so I'm gonna just go ahead and give you an example in the charts, and after that I will be doing the backtesting in the next video. So I can see here that I have an example. This is my high, all right, and the market did this. You guys have to get to know how to get used to these things. The market is doing like this, and then it pulls back to this level, and then it this like this, and then pulls back to this level. All right, guys. So what I'm gonna be doing is going through all the conditions. First condition is this: it's broke above this high and closes above it. The second condition is the moving average. I'm above, the market is above the moving average. So third condition, I'm gonna pull up my Fibonacci level from swing low to swing high, and this is my point. It touches the 786, and this is my point where I'm gonna be entering, and I'm gonna be putting my entry here and my stop loss just below 10 pips. Let's say 10 pips below the low, and then my take profit is gonna be just in line with the high. All right, and the risk reward ratio is 2.73, which is very, very nice. So that's how you can apply this, guys. I think this video is going like long. I'm gonna stop it here, and I will be doing the backtesting in the next video. Thank you so much for watching. Take care, guys.